So you're thinking about starting your own self-managed super fund. That's great. But are you aware of what's really involved? Let's take a quick look at a typical self-managed super fund. When you first set up, you need to decide on fund members and trustees, establish the trust and trust deed, set up a bank account, register with the ATO, create your investment strategy, and include a plan for when your SMSF ends. There's more to consider once set up, including rolling over of existing super, organising employer contributions, accepting contributions within limits, making investments without breaking rules, regularly reviewing the investment strategy, and documenting and maintaining records for up to 10 years. Then, each year, you need to value assets, prepare accounts and financial statements, appoint a registered self-managed super fund auditor, lodge the annual return, pay the self-managed super fund levy and any tax that's due. When you start making payments, you need to decide if any assets need to be sold, ensure minimum payments are met each year, and you may also need to appoint an actuary, withhold tax, and give payment summaries to members as well as the ATO. Finally, when the fund is finished, you need to get a final audit and lodge your final return. Plus, you'll also need to pay any outstanding tax and pay out or roll over all of the assets. As you can see, there is a lot involved. Before you decide to start a self-managed super fund, you need to consider whether you can manage everything or whether you are prepared to pay self-managed super fund professionals to help. But remember, even if you have professionals help, SMSF trustees are ultimately responsible for their fund. You may want to seek some professional advice to help you decide if a self-managed super fund is right for you. For more SMSF information, take a look at our other videos or visit the ATO website at www.ato.gov.au.